Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter again. It's going to be commodity, financial topics, wealth topics, maybe even relationship topics, because it does pertain to wealth sometimes if you're getting married or whatever. So I'm going to give my financial opinions around all those topics that we've got going on today. There's going to be a little bit more uranium mixed in here, since uranium does look pretty good. And we'll jump on through it. So let's get through it together. Again, if you want to follow me at @finance and finding-value.com. If you want to join the membership and see what my portfolio is, do the platinum question and answer sessions on the weekends where you can ask me questions and see my midweek updates. So we've got Encore Energy also fully, I don't know if it's IT, fully it bullish, but just so. Volume this prior week, very impressive. Could be the time to run. So this is Encore putting in its pattern. So you can draw a line through here. You can draw another line coming down through here, and it's broken out of that downtrend. I don't really use the MACD all that much. I know Michael Oliver calls it the wet noodle indicator. I completely agree with it. The more technical analysis you do, the less you use of these two. I have this myself, but the volume here is kicking up. That is something you want to look for. The volume kicking up, the broken down trend line, and we're starting to move on higher. We also have a bullish engulfing and another bullish engulfing, aka this could get pretty fun here. Let's put it that way. Coming down, he says a decent wedding ring should be about 25 to 30% of his annual income, said the lady to her friend sitting next to me. I don't care how much someone makes annually, but in my opinion, this is crazy thinking. What's the cost of your wedding ring? Well, it is crazy thinking. 25 to 30% of an annual income. That is ridiculous. What I would suggest, or what I would say, is if a girl is actually saying this to you, I would probably look for other options. I'm not joking. If that is a 100% requirement, I probably would say, okay, I'll just go with someone else. And that's what's difficult, though, because here's what's difficult. The females go after all these, we'll say a select few individuals, like a certain percentage of the population, which is not a very large percent, like 5-10% of the population. And you get those people get a lot of options, like a lot. And if you've got people telling you this, and you're a female and you're going after those top tier people that they're going after, you can just say no. you can go no next, and just keep going next until you find someone who actually cares for you and doesn't have stupid, financial requirements like that. I don't know. I just think that's way too much. That's ridiculous. I mean, imagine if someone makes a couple $100,000 a year. Are you going to spend $100,000 on a wedding ring? No, it's just stupid. Self-care is adding more money to your stock portfolio when your job pisses you off. Well, let me tell you about my job. So this is part of the reason that gave me motivation to start a YouTube channel. It gave me part motivation to start investing even back in the day. So when I first started working, I worked at a large aerospace company out in California, and I just looked around at everybody, at all the people that worked there, and I was like, man, I don't really want to be any of these people. I still do that to this day. I look around and I say, I don't want to be any of these people. I don't want to make this amount of money. And it was the combination of those two things. It was the lack of what I'll call it, like a true person that I really wanted to be. They just didn't exist there. And it's dangerous because, I mean, maybe I should have, in my 20s just said, screw it, I don't want to do this anymore and go and do something else, which I probably should have done. But I didn't want to disappoint people. I wanted to use the degree I went and got for and all that other stuff. But there was a guy that I did see. I was like, man, that job looks pretty freaking sweet. What he did is he owned a couple of apartment complexes in Central Coast, California, when I was going to college there. And he was driving a Corvette Z06. And he stopped by our meet. I was at a Honda Prelude meet because I had a Honda Prelude back then. He stopped by our meet and he was just talking about us. He's like, "Yeah, I own these couple of the couple hotels over here on the beach in Avila Beach." And I was like, "Dude, that's pretty sweet." And he's like, "Yeah, I'm just coming over here checking it." He owns a Viper. He owned a Z06. It's a couple other cars that I don't remember. And he gave us he gave a couple people a ride. Wasn't me, but he gave a couple people a ride. And he was like doing donuts and all sorts of stuff. And police pulled him over, but whatever. That guy, I was like, dude, that guy actually, he's laid back. He looked pretty fit. He was pretty cool. And I bet he was making a bunch of money. That was someone I was like, man, I could learn something from this guy. I mean, I was in college at the time, but I didn't really think to really connect with him or anything. I was young. He's probably only 19 or 20 years old. And that's somebody I was like, man, I kind of want to be that guy. I go to work, I graduate college some years later, go to work, and I look around, I'm like, I don't want to be any of these people. You're stuck in a building, you don't really see a lot of daylight, you're making all these, widgets or whatever it is, and you're not really making that much money. There's nothing there where I'm like, wow, I really want to be this person or whatever. And I still kind of think that to this day. So when you look at this, use that as self-motivation to get the heck out of it. Using stocks can be a way to get out of it, but I think it's better to actually go and find something that you really enjoy doing that can give you the pay that you want, so to speak. And maybe it might be tougher to do that. It might be a tougher job, but at least you've got that ceiling that's been raised, and whatever that is. But I can tell you that's what really pushed me into stocks. I said I need to make more money than what I'm currently making. Period. And it came from the job that I had, and that was I started off as an engineer, and I thought engineers, at least where I lived, which was in California, was very expensive. And I didn't make hardly any money compared to what things cost. And I could relate to people that are in the current situation of the housing market that are young right now. It was the same situation. And I just started piling money into investments. I mean, piling into it. But the problem back then is I didn't know what to invest in. I didn't learn it. I didn't know what to do. And I didn't even know where to learn. And this was basically when YouTube just came out. There wasn't a lot of places to really learn very much from. So I went into that, and that really pushed me into investments because I didn't really make that much money. I didn't feel like I was, I went through kind of, hell, I'll call it, going through college, and I don't think I was making that much money. But that's my opinion. Coming on down, John Quakes, widely followed metrics like SWU and conversion costs are flashing bright red signals. And it feels like something's about to break in the whole uranium ecosystem. Price doesn't lie. Price is now trending higher. And we can see a kind of a large continuation pattern that is being broken to the upside. So that definitely looks really good for uranium. Coming on down. So food for thought against that dominant housing shortage narrative. Check housing units versus full-time employees. No shortage. Check housing units versus population. Never been more houses per capita than now. Only 08 came close. Too many cheap dollars or too few houses. Okay, so let's break this down. Full-time employees to total housing units. I don't even know why this matters. Why is he using this data? Why does it matter, the full-time employees versus the total housing units? I'd have no idea why this even matters. I mean, all that matters is how many homes are on the market that are being sold versus the demand. That is your supply demand. You can't use this metric is completely worthless in my opinion. I don't know why you'd use it. Going to this is your total housing units to total population. I don't know why this is that big of a deal either. I know people who own multiple homes. I know a whole bunch of people that own multiple homes, a whole bunch. They own a regular house that is in a city, and then they own like one or two other homes in other areas that are off in the middle of nowhere. So even though you have a total population, that doesn't do anything. I mean, it doesn't matter that you've got a cabin way up in the north in northern Minnesota off of a lake. That's not going to house someone who works in Minneapolis or who works in Wisconsin or who works in Colorado. It just doesn't matter. And I don't know why this makes any sense to even show this. So the total housing units does not matter to the total population, because what matters is how many homes does each person own, and are they going to sell them? Or are those homes going to stay in families for a lifetime? I don't know. I don't know where this stuff matters. So the bearish arguments that are coming from these individuals are the weakest arguments I've ever seen. That's kind of like saying the total cars in America versus the total population. And then you say, well, there's far more cars in the United States than there is population. And you're like, so what? All that matters is who is selling those cars and what's the demand for those cars. Now, I'm not selling in our family right now, we've got 4 cars, and we have 2 licensed drivers. Does that matter? Am I going to go sell my cars? I'm not going to sell. I don't understand this data here. It doesn't make any sense to me. So that's what I'm going to say about that, and I wanted to share that. Wake-up call for bulls. The scope of the yield curve inversion is unprecedented. And you know what? This could go even further. So what this is doing is it's telling us something about the market conditions. We got inflation here, an energy crisis is what they call it, the Volcker shock part 2. What's driving this is all demographic. Demographic. Tech bubble, okay, that's a tech bubble, and that demographic was driving this a little bit. Then they pushed interest rates down, they held them low, and then they blew up a housing market bubble. That's the global financial crisis that they blew up. COVID pandemic, okay, and then we've got this, and this could be, we could get a pullback here with a flush out of all the crap in the system from higher interest rates. Totally agree. This is just telling us where we are in that cycle. The curve inverts before certain cycles. You get this inflation that comes in, interest rates follow, the curve inverts, and then it usually cycles back down. But it doesn't tell you that this is necessarily done. It doesn't give you the exact timing either. Depends how big that demographic is, depends how out of balance the housing market is, depends on all those things. So I'll just say that and leave it at that. It says the Fed needs high inflation to inflate the debt away. Even if they say otherwise, it's a tax nobody complains about. It hurts the normal people that don't have hard assets the most. Those that have hard assets will have their assets inflated. Yeah, I agree. And they're going to have to inflate this debt away, period. So if they don't inflate the debt away, what you're going to get is you're going to get a liquidity crunch and a credit crisis, because you don't have enough liquidity in the system to cover the debt. So they have to inflate its liquidity, the debt away. And that's what I'm positioned for. They can play hardball just kind of like they're doing, where liquidity kind of dries up a little bit. Then you get a credit crunch. Credit crunch is basically there's not enough liquidity in the system to cover the debt. That's your credit crunch. So you get a crunch, people default, and that those defaults cause a slowdown. And they're afraid of deflation or defaults. Defaults is a deleveraging type of process. And those defaults and that happen in the system from bad loans, they are a deflationary type move, and usually the central banks respond with print more money, inflation, lower interest rates. So they can play hardball, but they're going to need the inflation because there's just so much debt out there that they can't have a super credit crunch. A super credit crunch crashes the entire system. And they're not going to let the system crash, I don't think. So, keep that in mind too. I saw this. Patrick said an epic destruction of purchasing power happening right now. Levels last seen in 73, 50 years ago. Your best friends are gold, silver, and oil. I like how he's jumped on the oil bandwagon. I'm very much an oil bull, and it's the most inflation sensitive commodity out there. Platinum is another inflation sensitive commodity as well. That is one that should be on the radar. So this is historical U.S. purchasing power of the dollar. This is crude up top. This is the dollars, the red line going down. Your dollar lost 97% in 110 years. Crude oil has broken out of its trend line here. It is retesting. It says the 4-year rate of change has stayed negative since 1941. Oil was $2.90 a barrel in 1961, and you can see this gigantic move lower, and we've come all the way down, and now we're about to break to the downside for that dollar. It says a massive crude oil bull era is coming. We could see the massive bull era for crude oil back from 60s, that's 66 to 1980. We saw another mini bull cycle. This is the mini crude oil bull era from 2000 to 2008. That was the mini one. And you guys heard me talk about the mini commodity bull market versus the big bull markets. The big bull markets happened from 60s to 80. And then this is another one that's coming. It's going to be a big boy bull market. There's another one that happened back here in the 1930s as well. We have got the same setup where we've broken interest rates to the upside. These were massive interest rate up cycles during these other bull markets. And we also had the same setup at the beginning. That same setup is where stocks and bonds went down together because the interest rates went up as fast as they did. That happened in the 30s. The beginning of this bull market happened in the 70s, and it happened just here in 2021 or 2. And now we're gonna work our way lower here. So we've got the alignment of kind of the sequence of events that occur during these bull markets. The same sequence is occurring this time as well for the commodity bull market. Here's some more. This is Sunday uranium charts. This is Camco. So Camco is probably the best chart on the weekly deck, fully IT bullish. Break that top line, and it's on like Donkey Kong. Totally agree. I've already positioned in all these things. I'm just kind of sitting there waiting, and we're just watching this show happen now. And we'll see what happens. I like the U308. It's breaking to the upside, and I'm sure these equities are going to follow. So the Fed is coming out with some data this week. That is something to look for. He's making the comment, you're ready for the Fed to pause on Wednesday. Just my gut feeling based on the way the market is trading. So get ready for what they release on Wednesday coming up. They're going to be releasing some information. We could see some market volatility. So just a heads up. Soren, so this is 144 pages long critical materials assessment report to those with time on their hand. I just think I'm glad to be invested in uranium and lithium. So this is your short-term 2020 to 2025, and these are some of the assets that could be critical. So critical, so this is the importance to the energy movement, and this is supply risk. So these are the most important with the highest supply risk, and a lot of them are rare earth metals, cobalt, gallium, graphite, iridium, neodymium. Then we've got lithium, uranium up here, which are very important and also have some supply risk. We've got steel, nickel, magnesium, platinum. Hey, there we go, platinum, and silicon carbide. We've got fluorine and praseodymium, whatever the hell that is. Praseodymium. Aluminum, copper, silicon, and titanium, kind of in this middle area. And that's what it is for this criticality matrix. That's what they think, at least. And I've got investments across this board here. It says, company invested to lunatic level in uranium. Lobo Tigra says, build positions now, bear traps, go aggressively long uranium. You insiders bullish, Alex, the Gringo, and Chapman coming back in uranium spaces. Is this the most telegraphed breakout in uranium history? I don't know. I'm in it. I'm riding it, and you're not going to get my shares. Sorry, guys. At least not for a while. So I thought this was funny, guys. Walked into a hipster's coffee place, ordered 2 coffees. My wife grabbed an organic blueberry scone made with kale or something. Total $62. Wife paid without a flinch. Now I'm terrified of her and questioning my own existence. I just thought that was funny because, I mean, I would be like, wait, 2 coffees in this and it's $62 and you pay without a flinch? I'd be like, oh man, I don't want to pay for this. Yeah, so I agree. And I thought that was kind of funny. Here's oil. So we shared this in our latest Bison interest update, 2.6 million barrel a day estimated deficit in the second half of the year. And we won't actually get this deficit. The price will go up to balance the market, but that's from today. So we've got a 2022 surplus, China demand, rest of world, Russia cuts, OPEC plus cuts, U.S. production, non-OPEC production. We're sitting at about a minus 2.6 million barrel deficit towards the second half of 2023. So that's what it looks like, and that's the breakdown of it, at least their opinion of it. Thought that was kind of cool. So Ferg says the position size is the stop loss. So I want to talk a little bit about this as well. So some people are they set up these portfolios and they take on a lot of risk, and I think their position sizes could be wrong for the risk that they're taking. When I think of risk of it's basically something happening out of the blue for you, or the likelihood of something bad to happen. If I can't see a direct link to cash flow, I consider that to be risky, just in general. If a company already has the infrastructure in place, if they're already producing cash flow and all you're waiting for is the commodity to come back, I consider that to be a lot less risky proposition, because the generating cash flow infrastructure is in place already. Now you're just making a leveraged or super bet, we'll call it, to the price of the commodity itself, or to the service they sell, or whatever it is. So when I position size a lot of these companies, I position size based off the risk and my bullishness or bearishness of the commodity itself. So someone asked me, why do I think uranium is a lot riskier or speculative, because I always say that, versus other sectors? It's because they don't have a direct link. There's no direct sight for a lot of these companies to cash flow. They don't have the infrastructure in place. They don't have the finances secured. They don't have the mines and the employees and all these different things all kind of laid out. If you take another company like a large oil company, they've got all the infrastructure in place. They've got all the people in place. They've done projects and all these things before. And if they're going to expand more projects in the future, they've got everything in place to do that. Other companies do not. So I think that the risk is lower because they can fund those projects from existing production that they've already got in place. And I can see where the cash can come from. I can see that they've got the projects and the people in place to do it, et cetera, et cetera. That is what the risk is. And I position size all of those companies in a way that I take that risk into account. So if I see a company that can grow production massively, they're already producing a good amount, they're generating cash, they're paying me a dividend, the risk there is quite low. If you take a uranium company, I'm not picking on uranium, I'm just telling you the thing. You go into an exploration company, they haven't hit anything, they are raising capital by diluting shares and all that other stuff. I mean, that is very speculative. You are hoping that more money comes into that sector and pushes the prices of those stocks higher. So it's a different type of investment, and I position size those things differently. How to look at the market in the second half. He talks about the real estate market. I'm just going to kind of go through that. Want to see the most? Okay, so I already talked about this in the last one, so I'm going to end it there, guys. Let me get off this guy. I'm not going to stare at him. Okay, that's what I've got for today. Give me a thumb up if you guys like the content. Subscribe to the channel if you haven't already. Subscribe to the website if you'd like. But that's what we've got to share for today. Hopefully you guys enjoyed it. Hopefully it gives you a little bit of more information to think about. And we'll end it there. We'll catch you next time. This is Finding Value.